I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, December 20th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be with you for the next 30 minutes or so as we prepare for the market action again today. Yesterday, we saw a really broad-based advance. All 11 sectors were higher. We had 95 out of 104 industry groups that were higher. So a lot of the breadth, I guess, that some technicians have been looking for, we're finally getting a lot of that. Again, most of you know I'm not a huge proponent of breadth. I mean, I do want to see all areas of the market performing well. I think that's a much healthier environment than just having, maybe one or two sectors going up, just a handful of stocks. But I think the advance has been broader than most folks have recognized. And I've been into that before, so I don't really want to get into that whole lot more today. I do want to, though, welcome all of you to our live stream here. Periodically, I do like to just acknowledge those of you that take time out of your day to come in and join us here at EarningsBeats. I hope you enjoy the shows. Certainly leaving comments helps us so we know what you like, maybe what you don't like about the show. For those of you who are watching live or even are watching later on the recording, please remember to like the video. That really helps us in terms of getting our message out to a broader audience. And think about subscribing to our channel as well. It'll keep you up to date on all the events, all the things that are happening at EarningsBeats when we do have these live shows. Make sure your notifications are on, and then you can come join us. We do a number of live shows throughout the year. We do a number of shows that are open to the public. Obviously, we do a tremendous amount of other shows for our members throughout the year as well. This is a great time to join us. If you haven't already, make sure you go over to EarningsBeats.com. I'll show you a little bit later in the show how you can just go into our homepage, sign up for a 30-day trial. It's easy, it's simple, and kick the tires for 30 days. It also will save you a lot of money potentially on Market Vision 2024, which we have announced. It's absolutely my favorite event of the year because it requires me to do thorough research. It's kind of like, if you're going around your house, you're cleaning or something, you get the vacuum cleaner out, do a couple carpets or something. That's not really cleaning. That's not a deep cleaning. With the stock market, it's the same way. I mean, I'm always looking at some key charts every day, but when I go into this Market Vision 2024, I leave no stones unturned. I'm looking at all kinds of different charts. And then at the end of the Market Vision 2024 event, I'll actually give you a roadmap where I see the stock market going, and kind of lay out throughout the year where I see the potential ups and downs and why. If I have some time at the end of today's show, I'll give you a little bit of, I'll show you a little bit from last year's 2023 event where I did lay out 2024, and you might be surprised how accurate it was. But anyway, we'll get into all that maybe later in the show, especially if we have some extra time. But again, I want to welcome all of you. Thank you so much for joining. Let's get into the action yesterday. So here you can see on the major indices, I want to make sure that comes up before I get into it. I don't know, Tyler, are you there? I'm not seeing it up. There you go. All right. So Dow Jones Industrial Average yesterday up about 0.7%. S&P up 28. NASDAQ up 82. Mid caps up 34. Small caps up almost 4 points. On a percentage basis, you can see the small caps once again taking that leadership role, gaining almost 2 percentage points. Mid caps up 1.25. The others up about 0.5 to about 0.7%. Transports up 0.9%. Anytime you see the mid caps and the small caps, especially the small caps leading, you can think, okay, probably good breadth. Because the Russell 2000, if you look at the 3,000 largest companies on the Russell 3000, The Russell 2000 is the smallest 2000 of those 3000. So it's giving you a very, very broad look at many different sectors, many different companies that usually go under the radar that we don't talk a lot about. And these are the ones that are going to drive a lot of the breadth numbers that many of the technicians like to talk about. The thing that you have to understand about the stock market is that you go through periods of time where various asset classes lead and others lag. And for most of the last year, maybe last couple of years, small caps have underperformed. And so, of course, you're not going to get the broad, those breadth numbers that you're looking for, because some of the indices that have such a wide blanket over the market aren't performing as well. So if they're not performing as well, they're not going to keep up with the stocks that are driving the major indices, the NASDAQ, the S&P 500, where you've got 10 companies on the NASDAQ that control 50% of the direction of the NASDAQ. 10 of the 100 companies direct the NASDAQ 100 for the most part. On the S&P 500, those same 10 companies, or roughly those same 10 companies, produce or represent about 27%, I think. I haven't looked lately, but I think it's around 27% of the S&P 500. And so that's the thing that you hear on the news a lot, is that the S&P 500, especially the NASDAQ 100, has been performing better. And as a result, those, they're outperforming the rest of the market, and we're not seeing enough participation. I don't know that I necessarily agree with that. I mean, when you talk about participation, are you talking about how many of those small cap stocks and mid cap stocks, how many of them outperform the S&P 500? Or are you just interested in the fact that they're going higher? Because most of them have been going higher all year long, or at least a healthy dose of them. But they haven't been keeping up because the Magnificent Seven, if that's what you want to call them, those stocks, which are the ones that represent the NASDAQ 100 and S&P, have been having superb years. They continue, just to crank on all cylinders. They've got great customer service. They've got great products, and they just dominate the competition. I've talked about this before, so I'm not going to go into it anymore. But if you're worried about breadth, you should be seeing better breadth numbers. Just now, be careful of the people that are saying that we now have extreme breadth. It never ends. Looking at sectors, we've got energy rising 1.2%, communication services up 1%, materials up 0.9%. Those were your three leaders yesterday. We did have communication services, which is part of the aggressive sectors that I like to look at. But two of the neutral sectors that can go up or down in any market, energy and materials, they showed some pretty good strength yesterday. Materials, you can see, really lighting it up, had been through a very strong run, following along with the market, the overall market since the end of October. Energy, on the other hand, has been pretty weak. We know crude oil prices have been dropping consistently. They've started to turn back around again. If you're going out, going to get some gas, you're probably seeing prices edging back up again. That's because the crude oil prices overall are going higher, and as a result, many of these energy names are going up as well. So we're starting to see nice strength there. Maybe we continue to see that. I would not be surprised to see energy finish out the year pretty strong. We did get back up and close above 85 yesterday, which was a number I was looking for. That sent us above the 50-day moving average. I think energy could maybe make a run here. And a lot of folks, and I'm going to talk about this at 10 a.m. this morning because we have our live trading room coming up at 10 a.m. All EarningsBeats members are invited, by the way. So if you do take us up on a 30-day trial, come in and join us at 10 a.m. One of the key topics I'm going to talk about today is how do you trade an overbought market? Because the market is overbought at just about, no matter how you look at it, or what key momentum yardstick you use, we're pretty overbought. So what do you do with an overbought market? Well, again, we'll talk about that a little bit more at 10 o'clock. But one thing that I'll just mention is that areas of the market that haven't been performing well, do you look at energy? Do you think it's overbought? I don't think so. So if we are overbought, we do see some rotation for a period of time. Areas like energy, I think, could be super in the short term. I'm not advocating energy for 2024, but I do think over the next couple of weeks, I wouldn't be surprised if we make a move up toward 90. And if we do, there's going to be a lot of energy stocks that are going to be doing pretty well in the short term. So if you're long term, you got that mentality where you're thinking about 10 years out, you're not really worried about the overall market day to day. You don't care about trying to get into this stock or get out of the stock because it's overbought and into another one to try and capture a 5% move. You don't really want to deal with the market at that level. Just stick with the market. I mean, we've been strong. My signs certainly point to the market going higher. A pullback can occur anytime. And I like to try to figure out when it is. Obviously, as a trader, that helps if you can nail it. But it's difficult to pinpoint. I mean, folks have been saying now for the last couple of weeks, I was one of them, saying, hey, market's overbought. And for that reason, I wouldn't do anything with leveraged ETFs. Well, a leveraged ETF on the IWM would have been great. And of course, if we had hindsight, I would have bought a bunch of it 2 weeks ago or 3 weeks ago. But you have to evaluate the risk. And sometimes we just jump into positions only thinking about how much money we can make and not how much money we might lose if we're wrong. So anytime the market is overbought, first thing I'm thinking about is just maybe trying to determine how I can limit my risk to the downside. It could be using trailing stops, as simple as that on your positions. Just because the overall market is overbought doesn't mean the market doesn't keep going higher. And if you study secular bull market advances, you'll find that many times overbought just becomes more overbought, and more overbought becomes more overbought. And then you get ridiculously overbought. And by the time, if you're trying to bet against that, it gets painful. The other thing that happens in these bull markets is you tend to see smaller gains. Remember those days where we were up 3%, down 5%, back 2022 in the cyclical bear market, or even coming out of that with some volatility still up, the VIX up in the 20s. So, 3-5% days happened every once in a while. Sometimes they happen consecutively. Well, this is a different market environment. VIX is down in the 12s. And so what I've been saying is that it's been torture for the bears by 1,000 needles. It's not just come in and chop your head off. It's just poking you just day after day after day, because it's been boring action where the market just goes up a little bit every day. And that's the hallmark of a secular bull market advance. And it's perfect for me as a trader. It's my favorite type of market because I can get into my positions, whether they're ETFs or whether they're individual stocks that are trending higher, and just let them go. They're on autopilot. Seems like every day, the account just goes up following the market. Perfect. So there are different ways to approach it. We're going to talk about this more at 10 o'clock this morning. Industry groups yesterday did well. I mentioned 95 out of 104 industry groups went higher. And I don't track that every day. So I don't know whether that's some kind of a record or getting close to a record. I don't know if we've ever had a day where 104 industry groups go up, they all go up on the same day. But I thought 95 out of 104 was pretty darn high. Aluminum led that pack, gaining more than 6% yesterday. Remember, yesterday we featured steel. Today we're featuring aluminum, both of those starting to pick up. Is that going to have any kind of an impact as far as maybe inflationary pressures again? I don't think so, but certainly worth keeping an eye on. These stocks, if they do well, part of the reason they do well could be a stronger economy. Part of it could be the fact that the underlying commodity moves up. So those are things maybe to keep an eye on. But aluminum, great day yesterday, up 6%. And you can see after downtrending for the last few months, and even really since the end of October here, we had a decent rally. But then right before, I would say maybe the first 10 days of December or so, we went back down. We were close to the October low. The overall market, we never did that. S&P's just been going up. There's the NASDAQ. There's the Dow. The Dow's been maybe the craziest of them all. Hardly any pullback whatsoever for almost 2 months now. But seasonally, what do we talk about? October 28th, January 18th, best time of the year by far. I mean, if you're looking at, months at a time, there's no other period close to October 28th to January 18th. And I talk about it every single year, wrote about it, talked about it, did my shows, reported to EarningsBeats members. I mean, it's been really almost overkill, but this is when the stock market normally makes big moves, and we're seeing it again this year. Anyway, renewable energy finally making a breakout. So yeah, the overall market overbought. Renewable energy had been very, very weak. Now all of a sudden catching fire, breaking to about a 2.5, 3 month high. This is a group. If you look at the history of renewable energies or renewable energy stocks, it's either this or this. I mean, it doesn't just slowly kind of work its way higher. They're either in favor or they're not. And right now they're in favor. Been talking about them here over the last couple of days. Enphase Energy yesterday, the number one stock on the S&P 500. I think First Solar was up there as well. I don't know if it was, I think it was top 10. I don't know if it was close to Enphase, but some of these stocks are starting to show some strength. So again, you've got energy maybe to think about. You've got renewable energy to think about. Both of those areas of the market seem to be doing pretty well right now, and they're not overbought. Personal products, another area that did well yesterday, up more than 3%. You can see climbing back up, really just trying to print this V bottom. I mean, we went straight down. Now we're going straight up. And that's what we've seen across many areas of the market, where we've gone down. We went down through that or during that 3 month correction, July through October, and then coming right back up. Some areas, like some of the major indices, have taken out those July highs and gone right back. Others haven't quite gotten there yet. So anyway, that's it for the recap. Those were some of the highlights I wanted to go over. 10-year Treasury yield. Let's get a quick update here. There are a couple of economic reports out later today. I'll give you those. We have consumer confidence coming out later this morning. That'll be at 10 a.m. Excuse me. Consumer confidence expected to come in at 103.4 last month, and that's for the month of December. Last month, November, it was 102. So we're expecting consumer confidence to jump again, a little bit more than 1%. And then we've got existing home sales. And last month, or back in October, the number was 3,790,000 units. We're expecting that number to drop just a little bit to 3,775,000 units. I wouldn't be surprised if it moves up, maybe even above expectations. The one reason maybe why I might hesitate is that this isn't December. It's actually in November, and that's just when the rates started to kind of top and roll back down. So I don't know maybe if it's going to take whether existing home sales will jump in November or maybe it'll be December. But I wouldn't be surprised if we beat that number. We'll see what happens at 10 a.m. this morning. The 10-year Treasury yield, though, just continuing to do the opposite of the equity markets. Equity markets since October, straight up. As you can see on this chart, 10-year Treasury yield, straight down. So what that means is that money is pouring into bonds. Why would money pour into bonds when the stock market's doing well? Well, it's pouring into both. Number one, I think the bond market was maybe undervalued because a lot of folks were bailing with the thought that inflation was going to be a problem, a longer term problem. And now that inflation, and the Fed has even acknowledged it by raising the number of interest rate cuts for next year. But now that the Fed seems to be finally saying that, hey, we've got inflation in check. We're still watching it, but it's in check, coming down. I think that has now given a green light to many of those that want to be in bonds. So they're getting in, and as the money pours into bonds, that's sending the yield lower. And as the yield drops, that'll help on a number of different fronts, certainly with stock valuations. So I'm not at all surprised that we're seeing, many of those great growth names that have been leading the market. When you've got a decent economy and rates are dropping, I've been saying it for the last couple of months. That's nirvana. That is nirvana. I was talking about it when we were topping with a negative divergence on the 10-year Treasury yield, and the fact that we then fell back to a neckline. Talked about if that breaks down and rates keep dropping and the economy, we have a soft landing, which at this point certainly does appear likely. That's nirvana for stocks. It is absolute nirvana. There's no better environment. So why are stocks going up so fast? Well, I mean, think back to 2020, the pandemic. Initially, the pandemic scared everybody. The market went down. And then when we realized that a lot of those names actually would benefit from stay at home and rates dropped through the floor, went to all-time lows. I think the 10-year treasury yield dropped to 0.4%. When you start taking companies that, wait a minute, they're not going to be losing or they're not going to, their earnings aren't going to falter. Their earnings are going to explode, which is what many technology names did. And they're going to do it in an environment with crazy low rates. That's how you get a 115% advance in 22 months. Unfortunately, when you get down to 0.4% interest rate, and you've already seen a 115% move higher, that's where it helps to have a healthy dose of perspective, which is what we had going into 2022. And we said, be careful. Thought that maybe we'd be slipping into a cyclical bear market, which we did. Once that was over, then we kind of turned back to the upside. Interest rates, though, I mean, if you look at history, a 3.9% interest rate, 10-year treasury yield, is very, very cheap. I mean, it makes housing more affordable. People can buy houses. When interest rates in the early 80s, late 70s, early 80s went up 16% or whatever the high was, maybe I think it might have been 19%. You can't afford a house. What are housing prices? How are housing prices going to go up in that environment? They can't. So the fact that rates are low, again, use some perspective. Even going from 0.4 up to 5%, everyone thought that was horrible. Well, it's kind of bringing us back into the norm. 0.4 was irrational. That's not where rates should stay long term for it to be healthy. And so anyway, I think moving back down here into a more normal range is, excuse me, is really good for stocks. Anyway, S&P 500, let's move on. So one of the things that folks are saying now is that we're overbought. So seriously, it never ends. There's always going to be something that's going to be negative that's going to be shared on the media. Now, is overbought or are overbought conditions a problem? Yes, they can be a problem. It just means, I mean, how do you get overbought? You get overbought by the market going up relentlessly, right? Or going up a lot. How is that necessarily a bad thing? I mean, it's bad if you're sitting in cash or you're shorting, and you want to cover and you want to get out and you're like, man, this market keeps going up every day. I need a pullback. I mean, then it's bad. But if you're in the stock market and you've been all along, I mean, overbought conditions mean your portfolio is going crazy if you're just simply following the market. So it's not a bad thing. Temporarily, it can be a rough thing, and that's because of our market maker system. At some point, market makers, which are going up, we're going to see, and I'm still waiting for a reversing candle, which we really haven't seen throughout this advance. But that would be my first clue that maybe we're going to see a little bit of short term, because when you get that reversal, when everybody is essentially buying in the market, it takes market makers to kind of flip the switch to start selling, to get out of their long positions and begin selling, to begin the move to back down to the downside. Again, 2 weeks ago, we were overbought. 2 weeks ago, we had a negative divergence, or maybe a week and a half ago. There were a lot of signs where I'm seeing a lot more bullishness in the options world. 5-day equity only put call ratio has gotten down quite a bit. I think it's back down into the 50s. And by the way, it was in the 30s when we topped back in at the end of 2021. Right around 60 or 65 is probably the norm. If you went back, since they've been tracking the equity only put call ratio, I think a 5-day moving average around 0.6 is maybe right in that normal range. 0.6, 0.65, 0.62, I don't know, somewhere in there. But we're a little bit below that. So we're showing a lot of bullishness. So the masses are finally coming around. Remember, they've been so bearish in terms of options in the past, recent past, but they've started to become more bullish. So there's some reasons to think that, hey, we're going to pull back a little bit. In my opinion, it'll be healthy, and I certainly would be a buyer on that if I was in cash. At this point, I'm just letting things go. Show me a reversing candle, and then maybe I take a little bit of money off the table and see if I can get maybe a 20-day test or something like that to reestablish positions. Actually, if we get a 20-day test, I might move into leverage. We'll see. I want to see how it develops. A move below the 20, a long tail below the 20, coming back up, holding it, something like that would certainly get me a little bit more aggressive in terms of perhaps using some leverage. Because when you're near a major support level, and you use leverage, if you're wrong and the market goes down, you can get out without losing a bundle. The problem is here, and the reason I say I'm staying away from leverage while the market is so overbought and stretched is because what if I get in here into, say, the one of the leveraged ETFs? What is it? The SDS, which is the double on the S&P 500. I mean, the problem is if I get in here and then we just have a normal pullback to test the 20-day. I mean, look back here in June. See this move? Looks like a runaway. Then we gapped up, didn't really print a reversing candle, but we did at least finish on the low for the day. But anyway, that set up about a week of selling back down closer to the 20-day moving average. And then we ended up going back up to new highs. So that's kind of at some point what I'm expecting. Does it start today? Does it start, next week? Does it start at the beginning of the year? I don't know when it's going to start. Again, I'm looking for clues, but trying to find these short-term moves, to me, it's harder than trying to call the market a year from now or even 6 months from now. Because there's so many different ways to get there. But anyway, we'll see what happens. Continue to watch. And again, like I said, look for some reversing candles. NASDAQ 100, big move up. Again, overbought. Continuing to finish on the highs, though. And I haven't looked at stochastic, but stochastic's got to be well up in the 90s. I know RSI on some indices is up around 90. I think it's 90 on the Dow. So, yeah, we got some overbought conditions. IWM breaking out above 200. Volume still pretty darn high. So we're getting a lot of volume confirmation throughout this move to the upside. Look at the volume here. Do you see the move up here? Look at the volume. Maybe 20 to 30 million, occasionally 40 million. Go back here in this move, mostly 20 to 30 million. And then look at this right here. I mean, anywhere up to over 80 million, and just an average day is probably 40 million. There's a lot of money rotating into small caps. And those of you who look at this chart and say, well, this is where it's going to turn around. I think we're going through. I've been saying, I think we're going to go through. I think we're going to go back to that 240 all-time high. I don't know if it's going to be quickly. I don't know if this is going to continue and we're just going to go straight to 240. That's a possibility. I want to be in the IWM, that's for sure. And for those of you in the TNA, I congratulate you. I mean, I was in it a couple of different times and I got a nice little chunk, but man, I missed out on the big one for sure. The big move. But hey, I'm okay. I don't mind. I don't want to be overly greedy. And that sometimes is what you do when you chase and market's already up quite a bit. So I'm fine with just the IWM. It's been having a great run. So if you're sitting in the IWM, just be patient. Wait for a chance to do the TNA. There'll be chances. If we're uptrending and going to 240, there's a chance, pretty good one. Somewhere along the way, we'll have a decent pullback and have an opportunity to catch it there. Transportation stocks. Transportation continuing to do well. Also, look at the bounces off the 20-day. That is the hallmark of an advance. When you got the PPO rising, pullbacks generally hold the 20-day. Generally, not a guarantee, but that's normally what I'm looking for. When we get a pullback, I'm expecting the 20-day to hold. I'm going to get a little bit more aggressive when we're on that 20-day. All right, so here's I'm over at EarningsBeats.com, my home, and right here, you can't miss it. Start your no-cost trial, 30 days for free. You have to give your credit card. We have to enter it in our system to set you up. But We will not charge your credit card without notifying you first that your 30 days is expiring. And if you happen to like the trial, you're going to want to become an annual member before your trial expires, and you're going to want to do it before the Market Vision 2024 event. And the reason that you're going to want to become an annual member is because annual members get to come in for free. So our annual membership is $997. I know that's it's not small peanuts. I think we're worth every penny of it. I think we have a lot of members that believe that we're worth every penny of it. We have some members writing in saying, I'd pay a lot more for your service. Maybe we'll set up a special membership group just for you if you want to pay us some more. But give us a shot. What's it? 30 days for free. We can't do much more. Most everyone either charges a nominal fee for their trials or only gives you a free trial for maybe a week. We give you a full 30 days, a full month to take a look at our service just to see if it can help you, either from an educational perspective or in actually trading your account. We provide a lot of research to our members, Excel spreadsheets, chart lists that they can use. They can absolutely just download immediately. Might take me 200 hours to do the research, but our members get it literally in seconds by download. We do a lot for our annual members, including giving them free entrance into our Market Vision 2024 event. That's a $697 value if you're coming in from the outside. And even if you're a trial member, you get 50% off. That's a pretty good deal. So just take us up for 30 days. What have you got to lose? I can promise you, listen, my background is in public accounting. I had to pass an ethics test. Ethics, integrity, character, those things are really important to me. We're not charging you if you don't want to be charged. I mean, if you commit, that's a different story. Come in, check us out for 30 days. And then if you like us and you think that we're worth the value, become an annual member. You won't regret it. But anyway, again, we will let you know. I know personally for me, I struggle with subscribing a lot of times. It's not that I don't subscribe, but I feel like I want to make sure that I'm not just going to keep getting charged because I've forgotten about it or something. You know what I mean? We're going to reach out to you and we're going to tell you, you are expiring. You need to either cancel or you're going to get charged for a month. So we do everything we can. Anyway, scroll down, register now, Market Vision 2024. You can go to that landing page. If you just want to try us out for a little while, this one's free, no credit card required. This is our free newsletter, Monday, Wednesday, and Friday. EarningsBeats Digest, name and email address will set you up. And you can unsubscribe at any time. Anyway, that's all I'm going to sell for today. Let's move on to the chart of the day, which is Wayfair. It is a little bit after the open, so I apologize running a little late. I got a couple things here I do want to just show you real quick. Wayfair, I like using our short squeeze chart list from time to time. And Wayfair is one of those stocks right now where we saw a big move right here. We went from 50 to 67 in 2 days with volume doubling the average volume. And so when these moves get started, they can really run. So what I like to do is take small positions. If I knew it was going to 90 to test this high over here in August, I would load the boat with it. But you don't know that. Many times these stocks will revert and go right back down, and you can be underwater by 10, 20% pretty quickly as well. So if you are of the gambler's mindset, that's what I think is required. I mean, if you like going to Vegas and, hey, you know what, you lose $1,000 or 10 grand or whatever, your level of your threshold of pain is. But whatever it is, if you go and you say, oh, well, I had a good time and okay, I lost some money. That's part of the risk of going out there, blah, 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 and enjoyed myself. If you've got that kind of mentality, then maybe you should think about some of these short squeeze stocks when they get going, because literally it is like sitting at the roulette table. I mean, your number's called or it's not. And so, except I do think the odds maybe are a little bit better than the roulette table. Anyway, I think Wayfair looks pretty good. I'll give you an update. I don't even know where it is this morning yet. Down a little bit today, down 69 cents. But overall, I do like this breakout. I like the increase in the volume. The downtrend seems to be over. And the other thing is that I didn't show is look at how home improvement retailers are doing relative to the S&P 500. I don't know if you've been watching like Home Depot, Lowe's, more so Home Depot. It's been straight up, kind of like the Dow. But this group has been strong. And so that's another influencing factor sometimes when I'm looking at a stock and I decide whether or not I'm going to get in. If it's in a group where money is rotating into that group, I feel like I've got a better chance of making money in a stock that's in that group. And so that's part of the reason. Anyway, I took a position here a couple of days ago. I think it was Monday. And it was getting close to the open on this gap up. And I just took a small position. Again, it's nothing that's going to break me to the downside. I'm not necessarily going to get rich off of it, but I can make pretty good money if a short squeeze really does kick in. And by the way, one stock that I'm getting a lot of questions from members because I did talk about it back here. Let me annotate this one. This is TG Therapeutics. Again, not for everyone, certainly not after this move. But if you saw this big gap down, I kept talking about this is a stock that had 27% of its float short. And so when you get a breakout, all those folks that have been shorting at some point need to cover. I mean, if you've been shorting down in this level after that gap down, which is that's when the short percentage of float really jumped on this stock. So you got a lot of people down here that shorted. And the latest short squeeze report or latest short squeeze list that I just saw just came out. So I'm going to be doing the short squeeze chart list. I'll be updating that for everybody pretty soon or for our members. But when the new one came out, the short percentage of float is still the same. And you can pretty much see that the volume, while it has been stronger during this move, I don't know that the shorts have yet begun to get squeezed. That's really exciting. I mean, we got in, I got in, and when I talked to members, I talked about getting in at 12 or over 1188, a close above 1188. Here was the day, it closed at 1207. And look at this stock now. It has been maybe a month. It's been right about 1 month. And the stock has gone from 1207 to where it is right now, 1846. It's up 50% in a month. So these are the types of moves that you can get with short squeezes. And we have a whole chart list dedicated to it. I don't know, probably 40, 50, 60 stocks on there. They're the most heavily shorted stocks. And what we do is we watch them. Most of those heavily shorted stocks, by the way, don't do this. Most of them keep going down and down. There's a reason they get shorted. But just like when stocks go up and we get in on the long side, are we always right? Do we always know that earnings are going to keep growing and that stock's going to keep going up? No. Same thing happens on the short side. A lot of stocks get shorted, but they're not always right. The shorts are not always right. Sometimes you get these stocks that reverse back to the upside. You know, GameStop from a few years ago, that was quite a story, going from $7 or $5 or whatever it was to 500. That's how a short squeeze can really pound you. But that was kind of a one-off kind of a thing. Not too many companies do that. That was probably the greatest short squeeze of all time, at least the greatest one I can remember. But anyway, TG Therapeutics, I wanted to mention that. Last thing I wanted to talk about was the S&P 500. And let me give you an update here, just see how 47, we're down 7 right now on the S&P. So anyway, I'm seeing kind of a cup off of a long-term uptrend. Hopefully, you can kind of step back and see that. Started with the cyclical bear market, then we resume the secular bull market. And now I think we got a cup. And, if we get a little bit of a handle, maybe drop 100 points, wouldn't be a horrible thing. But a breakout, 4,800 down to 3,500, that's 1,300 points. 1,300 points. That's the measurement. If this does turn out to be a cup, we get a little bit of selling or even just a little bit of sideways action and break out, the measurement 6,100. Just saying. And for those of you who thought that maybe this was going to be a secular bear market here, I think you can tell now at this point, at least you should be able to tell that we are resuming this push to the upside. And you might say, well, oh, no, double top. Well, Dow's already broken out. NASDAQ's broken out. Many, I think the XLK's broken out. XLI's broken out. All of them to all-time highs. So, I mean, I guess, yeah, you can point to this chart and say double top, but what about all the others that are starting to break, especially key level? I mean, when you talk about the NASDAQ, which is home to most of those growth stocks, leading the pack to the upside and bringing technology with it and semiconductors, those stocks don't lead heading into a recession or into a secular bear market. Come on. Study history. Wall Street is pouring money into aggressive growth stocks. You don't do that right at a double top. Double top. Yeah, double top is there. Every time you pull back and go back up to the most recent high, you have a double top. I mean, here we went down, came back up. We had a double top. And a lot of people thought we were going back down. Did we? No, we went right on through. Here we went down. At some point, we had a double top. This one actually did roll back over. And then we came back up, double top, little handle, if you will, and then back off to the races again. Here we pulled back, kind of had more of a double or triple bottom, but went through a period of consolidation. We broke out. We took off. I'm not fearing a breakout. Now, listen, if we break out, then all of a sudden we come back down and we lose, let's say we get up to 5,000, and then we come back down and lose, this level, which I think would be a critical level at that point. That would be down at 4,100. I mean, if you haven't already seen it, some of the other signals, that would kind of be beating you over the head at that point, that we got some problems. But to sit out and think, oh, we got to get back down to 3,500, or if you've been shorting, if you were chasing that move to the downside and you're still on the short side, I don't know what to say. But anyway, let's get a quick look at the market. I know we went a little over, and we got a show or a trading room opening in 20 minutes. So I do need to go and get ready for that, finish getting ready for that. Anyway, we've got the Dow down 79, S&P down 5, NASDAQ's up 11.5, just doesn't want to quit. Small caps, yeah, we got that down a little bit, but all in all, not bad. And look at the VIX dropping again. I mean, this right here is such a warning sign to the bears. I know listen, bottoms form when the VIX is at a low, generally speaking. That's when you're going to get bottoms. So there are some that look at the VIX and say the market's got to go down because the VIX is low. Eventually, you will be right. But I would encourage you to look at secular bull market advances when we see the VIX declining and down below 13, because there are times when we continue to stay below. And I would say at this point, I wouldn't fret too much unless I see the VIX getting above 17. Anything below 17, I mean, if you get a pullback, the VIX is going to go up. So during a normal pullback, I could see the VIX initially getting to 14, 15. And then if we rally a little bit and then start to sell off a little bit more, maybe like an ABC kind of a move to the downside, maybe we see that VIX climb above 15, maybe it hits 16 or 17. But I just don't see it going up much more than that if it gets there. And usually you just see that kind of a move on the VIX when you're just kind of sideways consolidating. And then I would expect another explosion. I think the VIX would quickly return back down to 12s, even lower. That's what I'm seeing currently. So I don't fret a low VIX. I've done studies that tell me that when the VIX is at this level, it's when the stock market does its absolute best, period. End of story. Do the research. Anyway, that's it for me. Hey, come in on our 30-day free trial and join me in about, 17 minutes. And I'll go over some of the things that I would be looking for in an overbought market from a trading perspective. So if that interests you, take out your 30-day trial and come see me in just a little bit. Have a great day, everybody. Happy trading. And I will be back tomorrow for your next Trading Places Live. Spread the word, click the like button, subscribe. Those are things that can help us here at EarningsBeats. Thanks, everybody. Have a great day. Happy trading.